Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and in today's video, not only am I going to show you 3 stocks I'm buying for our 2021 portfolio, but I'll also share one of the most important lessons in investing. Our portfolio on StockCard.io has surged over the past few months, up 32% and beating the market by 25%, but it's been on the back of really just a handful of stocks. We've added 9 stocks to the portfolio so far with strong exposure to energy, financials, and healthcare, 3 of my favorite sectors for 2021. But we're missing out on a lot of the market. If returns on those 3 stock sectors were to slow down, this portfolio could be toast. And even if they don't, every portfolio needs a little diversification. Now, I'm not talking about the kind of diversification that kills your returns, the kind Warren Buffett says is protection against ignorance in your stock analysis. Buffett's own Berkshire Hathaway portfolio has 45 stocks, so you can hold a couple of dozen stocks and still make those outsized returns without being too diversified. No, what I'm talking about here is being able to spot the gaps in your portfolio, where you're missing out on those opportunities, and what you can add to not only boost returns, but lower your risk. In this video, we'll review the 2021 Bowtie Nation portfolio, which stocks I'm buying to beat the market. Then I'm going to use that to show you how to find the gaps in any portfolio, how to find stocks to buy, and the 3 stocks I'm buying in February 2021. If you haven't checked out the StockCard platform yet, I'll leave a link in the video description below. I've been using it for about 4 months now and love how it simplifies some of the ratios and that fundamental analysis that we talk about on the channel into these easy to understand stock cards. So use the link to check that out and follow the 2021 Bowtie Nation portfolio. It's free to follow and you'll get notifications anytime I buy or sell from the list, even before these videos come out. And as a special bonus, I've negotiated an exclusive discount for everyone out there in the community. Use the promo code BowtieNation, all one word in lowercase, for an exclusive discount beyond that free trial. Now, I know you want me to get to the goods, but I gotta send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So here we are on StockCard, and I've got these sorted by when we added them to the portfolio, and you can see those first 3. Diamondback Energy, ticker FANG, CVS Health, ticker CVS, and Citigroup, ticker C, we're all in those 3 focus sectors of energy, healthcare, and financials. They're up from 24% for CVS to 97% for Diamondback, and I think they can go higher throughout the year. Oil prices are 35% higher from October on that economic recovery and the weaker dollar, 2 trends that should continue all year long. Healthcare is benefiting from a return to that normal on health spending, and the banks are realizing that the recession isn't going to hit them as hard as they thought. And besides these big picture fundamentals, all 3 of these stocks are good value plays in those sectors, so we're going to hold on to them from here. I added EMCOR, ticker EME, as a play on the potential for infrastructure spending and renewables in October, with a 33% return so far. Anthem is one of the best insurers out there and another play on that healthcare theme. And here we actually took some profits in Lyft after the shares shot up 42% in less than a month. Now, we've actually sold 4 of the stocks in the portfolio already, but for different reasons. For Lyft, it was still very early in the recovery, and I was worried that that early bump in the shares was just going to evaporate. The shares are up another 30% from here, but you gotta be happy with a 42% return in less than a month. Nation, second guessing your decisions is just going to stress you out and won't make you a better investor. We're still waiting for shares of First Energy, that's ticker FE, to rebound, but collecting a 5% dividend while we wait. Devon Energy and Renewable Energy Group are 2 more that we took profits on pretty quickly, making 54% and 30% in about a month on each of those. Now for these, it was about hedging that risk to energy just a little. At the time, we had only 9 stocks in the portfolio, and 3 were in energy companies, so I wanted to keep Diamondback and sold these 2 out. Now here, AT&T isn't a stock that's going to set your bet on fire, but it's hard to beat that 7% dividend yield, and I do think the shares are undervalued right here. We're already at a 25% return on United Microelectronics, that's ticker UMC, and 11% higher on Wells Fargo, ticker WFC. Now, I just flew through those because I want to get to spotting those gaps in your portfolio and those 3 stocks that I'm adding to the portfolio this month. If you want detail into why I added each of these stocks, the complete analysis, I'll leave links to each of those videos in the description below. But now, to find where you need to add stocks to your portfolio, you want to start by looking at the sectors that you have stocks in and which you're missing. The graphic here shows the 11 sectors of the economy and major industries within each. And I'm not saying that you need stocks from every single sector in your portfolio. It starts with that big picture analysis. What are the broader market forces that are benefiting certain sectors, And where can you find those best opportunities? Now, looking back on our own portfolio, we've got telecom, healthcare, financials, energy, industrials, and technology, but nothing yet in those consumer staples, discretionary, or shares of materials companies. And each of these three stock sectors has some real room for growth this year, growth that I don't want to miss out on. For our first edition here, I'm buying WW International, ticker WW, formerly Weight Watchers. Now, a lot of the good rebound stocks and consumer discretionary names have already rebounded this year, even if they're not out of the woods yet. Shares of Carnival are up 40% from November, and Macy's is up 130% against what's probably a slow death for department stores. But we could be coming into a very strong period for consumer spending. The personal savings rate hit 33% during the pandemic, a record high, and at 13%, it's still higher than any point in the last 5 decades. Nation, when people do start getting out later this year and actually spending that money, you could see a boom in some of these consumer discretionary stocks. And while Weight Watchers isn't exactly what you usually think about when you think about a shopping spree, I really like it here for another reason. People got fat during the lockdowns. Yeah, you can't see it here, but I've had to kick my ass at the gym and eat, well, pretty much nothing for 6 weeks just to get down to my pre-pandemic weight. It happened to a lot of people, and the first place that they're gonna run so they don't look like Jabba the Hutt when they start going out, Weight Watchers. The company is the leader in the $60 billion global weight management industry with more than 900,000 active subscribers managed by 8,000 coaches and 3.8 million digital subscribers. Now, the lockdowns did hurt its in-person business, but the company has worked to expand that digital offer, and I think both of these come back strong in the summer. Analysts have an average price target of $32 a share, which is nearly 30% above the current price, and the stock trades for just 18 times earnings. After a lot of research, I'm actually still looking for a stock in the materials sector that I like, so let me know in the comments what I should be checking out. I wanted to add something with exposure to the agriculture space because crop prices are just booming, but material input stocks like Mosaic and CF Industries, they've already run up so much and are now coming back down. Researching the theme though, I do like Zoetis Inc., ticker ZTS, the $75 billion leader in animal health medicines. Now technically the company is in the healthcare pharma space, selling vaccines and other drugs to the livestock and pet market, but both of these segments have those strong cyclical trends in their favor. Livestock prices have followed other crop prices higher this year. This chart is for hog futures on the CME, up 20% since last July. And that companion pet market saw its own boom last year as well. People getting dogs and cats to keep their sanity during the lockdown. So both of this company's segments are doing really well. And Zoetis is a clear leader in this market, a part of Pfizer until its 2013 spinoff, with about half its sales from livestock and the other half in that companion pet market. Shares trade a little expensively here at 45 times earnings, but they always trade that high. The lowest the PE ratio has been over the last 5 years has been 36 times, back in 2018. The company has been blowing away earnings estimates, and I think the trend is just getting started. Zoetis beat earnings estimates by 19% last quarter and 39% in the previous. Next here is consumer staples giant, the Clorox company, ticker CLX, and honestly, I kind of hesitate to add this one because I don't think it's going to zoom higher, but right now is a great time to add it to your long-term portfolio. Really the entire consumer staples sector. So a lot of your food processors, your household goods companies, they've all sold off hard since August. Now shares of Clorox are off the August peak by nearly 11% on that idea that as people get out of the house, they're gonna need less of these household names. Instead of eating their cornflakes on lockdown, people are gonna be having a donut at work. Instead of wiping their ass at home, people are going to be wiping it at restaurants and at the office. So with Clorox, you've got a stock paying over a 2% dividend yield and has produced a 16% annualized return over the last decade. It's a well-run company with stable cash flows. I mean, I don't care how much people go out, they're always going to need to wipe their butts at home. But you see, my hesitancy here, adding it to the portfolio, is only because this isn't the kind of stock that's going to set our portfolio on fire with those high double-digit returns. But for all you out there looking for those buy and hold stocks, this is it. Click on the video to the right for my top 3 electrical stocks that don't rhyme with Mesla. 3 great EV stocks to ride that trend higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.